So here we are with 1.2 Goods and Services Tax, which is GST and PST. Also going to introduce something called the Harmonized Sales Tax for you as well. We're going to talk about all of those things and in the different provinces. It's on page 310 of your textbook if you're following us. In Canada, the federal and provincial governments impose sales taxes on goods and services sold. The companies that sell taxable items become by law the government's agents for the collection of the sales tax. A customer pays sales tax to a company and the company sends the money to the government. Service companies, manufacturers, wholesalers, and most retailers are required to register with the federal government to collect either the national GST or the harmonized sales tax, and in Saskatchewan we don't have HST, we have PST. So here's something to refer back to. It goes by province. Some provinces pay PST and GST, some pay just HST, some just pay GST and no PST. So if you look at in Saskatchewan, we pay 5% PST and 5% GST for a total of 10. So I'm not going to go through all of those, but you can refer to them if you need them later on. Business number, the Canada Revenue Agency registers companies and issues a business number. To obtain a business number from Canada Revenue Agency, you need to complete this form. And if you look on page 312, there's something there. And it just registers your business, gives them a business number, and it gives you then the right to collect the GST. The GST is a 5% sales tax charge on most goods and services by the federal government in all provinces and territories. So you have no option on paying the GST. So an example would be if you are buying something for 100 and there's 5% GST, the amount of GST would be $5, so the total cost would be $105. Same example, but in Manitoba, it would cost you $112 because of the way their taxes are set up. And the harmonized tax would be $113 based on how it is set up. We're going to kind of talk about how the GST is set up and paid and collected. Just know that we're not going to be doing it this difficult way. As I continue on, I'm going to show you a much easier way to collect the GST. But I just want to kind of go through this with you. A product can be bought and sold by several businesses before you, the consumer, actually purchase the item. In the chart below, a wholesaler purchases a mountain bike from the manufacturer, who buys parts from various suppliers. The wholesaler sells the bike to a retailer, who in turn sells the bike to you. Each business involved in getting the bike to the customer must add 5% GST to its selling price. However, the federal government receives only 5% of the final sale price. Now, how is this possible? It's possible because each business sends the federal government only the difference between GST collected and GST paid. This is the big deal here. It ends up sending in taxes collected only on the monetary value added to the item by the business. A business collects 5% on the price of all eligible goods and services. Before remitting or sending the tax collected to the federal government, the business deducts all GST paid to other businesses when purchasing goods and services it uses in the ordinary course of its business. This deduction is called an input tax credit. The input tax credit ensures that the federal government is not receiving more than 5% GST on the final sales. So let's follow the mountain bike through each step below and see how the GST system actually works. So the materials sold to the manufacturer were 100, collecting a GST of $5, and the amount remitted was $5. The mountain bike, so that's that one. The mountain bike is sold to the wholesaler for 400. GST collected is 220. The GST input tax credit is 5 because that's coming from here. So the amount they're going to remit is going to be 15. Now the mountain bike sold to the retailer for 500, and you can continue on there. So this here now goes to here. The mountain bike sold to the customer for 700, GST collected is 35. We now have $25, so the amount that they're going to remit is $10 for a total of 35. In this example just presented, the retailer sold the mountain bike for $700 plus 35 GST, but sent only $10 because they took the $35 GST minus the 25 input tax credit to the federal government. This represented the GST collected on the value added by the retailer to the final selling price. The federal government received in total 5% of the retail sale price for 35 in GST in stages from all the businesses involved in getting the product to the final consumer. So they didn't receive it all at once, but they did eventually in all of the steps. Since companies are responsible for collecting GST or HST from customers and paying it to the federal government, they require a ledger account to determine the amount owed to the government. Depending on the tax being collected, a payable account is used to record liability for the tax collected from sales. We're going to use a contra liability account called refundable is used by the company to record the tax paid on merchandise and items it purchases in the course of its business operations. The amounts paid are called input tax credits. So GST payable is a liability account used to record the GST collected on sales from the customers. The example below shows how the GST is recorded and tracked. The amount of GST paid on purchases is a contra liability. It is therefore debited to GST refundable. Okay, so the GST payable is $1,426.10. If they go into the GST refundable and they will subtract that, the GST owed to the government will be $445.47. So notice that GST refundable is going to be a debit, GST payable is going to be a credit. And the journal entry would look like this. You have your GST payable as your debit, and then these two credits will equal the debit. And the same thing goes with HST payable. You just have, it's just now HST refundable and HST payable. You still subtract them. Your journal entry still looks like this. Provincial sales tax is charged on retail sales price of goods sold to consumers. The tax is applied only to tangible commodities, although a few services, such as telephone service, are taxed. Such items as food, drugs, children's clothing, school supplies, and farm equipment are exempt from PST. So PST doesn't get charged to everything. And you can see in Saskatchewan we have a 5% PST. An invoice, okay, PST exemptions. Notice a PST exempt stamp on the invoice. This is because the buyer uses the paper to produce items it prints, such as greeting cards. So the paper becomes part of the greeting cards. PST is charged only when the cards are sold to the final user of the cards, not when they're buying the paper. So when they're purchasing the paper, it's PST exempt, but when they're selling the cards, they'll have to charge PST. Okay, so there it is there, and it says sales tax exempt. Okay, and if you look here and want to find, now we're putting the GST and the PST together. And so I think that's pretty straightforward. You can refer back to it if it's not. And if you want to look at it this way through a journal entry, you would have your purchase. Your GST refundable is 25. The cash credited would be 525. Okay, and here this entry is made when the bike is sold by the retailer, so it's selling now. You're receiving the 735. You need to pay that back to the government, and the 700 will go to the sales. Okay, same thing goes if you're talking about PST or HST, looks exactly the same like this. And the entries made when the bike is sold to the retailer looks like that. Example 3, provinces that have a PST and a 5% GST, it would look like this. So something else you can refer back to. It's just separated, GST, PST. As a retailer in Manitoba, Red River Sports is responsible for collecting the PST from customers. The accounting system must be included as a PST payable. Okay, so I think you guys know that one now as well. Okay, GST, HST, PST, and cash discounts. Okay, I'm not sure I need to go over that one. You can refer back to that one as well. Several provinces pay commissions to businesses in return for the collection of PST. Prince Edward Island pays a commission of 3% to a maximum of 500 per year. Just a way of giving back to the companies that collected on their behalf. So they're using a sales tax commission account there. Okay, now this is the quick method of accounting. The quick method simplifies the procedure used for paying GST and PST to the federal government. This method is used by all small businesses with annual sales of less than $200,000. The quick method reduces the amount of paperwork and record keeping for businesses that choose to use it. With quick method, the GST HST is collected on sales in the usual way. However, the change occurs when you calculate the amount to send to the federal government. Okay, so here are the steps. You collect 5% GST or the HST on all sales. Then what you do is you multiply the total amount of the sales plus your GST by 1.8%, for example, to determine the GST owing to the government. The government decides what that amount's going to be. Then you send the tax owing to the government. The 1.8% rate shown in the example above businesses such as delivery services, dry cleaners, auto repair shops, caterers, fast food outlets, travel agents, and so on. There are other rates for different categories of businesses and depending on whether the province participates in HST. The rates and other conditions applicable to use of the quick method can be obtained from the Canadian Revenue Agency booklet. They would tell you what your percentage would be. When a business uses the quick method, it does not need to keep track of all the GST and HST it pays on purchases. The lower quick method tax rate sent to the federal government takes into account the HST, GST paid on purchases. The part of the tax not remitted to the government makes up for the input tax credit on purchases that is not claimed. Suppose that for GST, HST reporting period that closed at the end of February, a company made sales of $10,000 on which $500, that's 5% of GST was collected. The total sales plus GST are $10,500. When the business sends a GST to the federal government, this procedure is followed. The amount of sales plus GST for the period is $10,500. Assume that GST quick method rate is 1.8. All you need to do, you don't have to keep track of anything. You take the total and times it by 0.018, which is 1.8 divided by 100. That's where that number is coming from. And it equals 189. Now that's way easier than keeping track and subtracting and so forth. Your journal entry would look like this now. You have to pay a cash of 189, so that's a credit, and your GST payable is now 189. Okay, this is what a form would look like. It's kind of hard to see, so if you look at page 325, it gives you a better idea. That's all you would have to fill in for your goods and services tax to show where that 189 is coming from. And that's it. So I went through that kind of fast again. Feel free to stop and go back and have a look. And like I said, we're going to be using the quick method, so hopefully that helps you.